You just got the call. A relative has passed away, and you are about to inherit a significant sum. Maybe it's $200,000. Maybe it's $2 million. You feel a mix of grief and a sudden, secret surge of relief. You think your financial problems are over. You think you've won the lottery. Stop right there. I need you to listen to me very carefully. That money in the account, it is not a windfall. It is a test. And statistically, you are about to fail it. Studies show that 70% of wealthy families lose their wealth by the second generation. By the third generation, that number jumps to 90%. We are talking about fortunes built over 50 years vanishing in less than a decade. Why? Because heirs treat wealth like a fuel tank to be burned rather than an engine to be maintained. In 2026, the rules of inheritance have changed. The great wealth transfer is happening right now, but the tax code is shifting, inflation has changed the math, and the old strategies of put it in a savings account and forget it are financial suicide. Today, we are busting the biggest inheritance myths wide open. We are going to look at the tax traps that catch heirs off guard, the step-up basis math that could save you a fortune, and the exact steps you need to take to make sure you don't end up as a statistic. This is the Inheritance Survival Guide. Let's start with the most dangerous myth of all. Inherited money is tax-free money. You might have heard that you don't pay taxes on an inheritance. In the US, generally, the estate pays the tax, not the heir. But in 2026, we are facing a massive legislative cliff. The higher estate tax exemptions passed in 2017 are set to expire at the end of 2025. This means the threshold for when the government takes a chunk of the estate is dropping. In 2025, an individual could exempt roughly $13 million from estate tax. In 2026, unless Congress acts, that number could drop to around $6 or $7 million. Let's do the real math. Imagine your parents built a successful business or portfolio worth $10 million. If they passed away in 2025, the estate might have paid zero federal tax. If they pass away in 2026 and the exemption drops to $6 million, the taxable estate is now $4 million. The federal estate tax rate is 40%. That is $1.6 million gone to the government immediately. That is the tax cliff. If your family's wealth is hovering near that line, you cannot afford to be passive. But even if you aren't a multimillionaire, there are other hidden taxes. The step up in basis is the single most important concept for the average heir, and most people mess it up. Here is the scenario. Your father bought a stock 20 years ago for $10,000. Today, it is worth $100,000. He passes away and leaves it to you. Myth: you inherit the stock at the price he bought it. Reality: you inherit the stock at its current market value on the date of his death. This is the step up. If you sell that stock immediately for $100,000, you pay zero capital gains tax. But what if the estate executor doesn't know this? What if they panic and sell the stock before they distribute it to you, while the estate is still open? They trigger a capital gains tax on $90,000 of profit. At a 15 or 20% capital gains rate, that's a tax bill of roughly $15,000. Money lit on fire because of a clerical error. Step 1. The asset audit. Do not touch the money. Do not sell anything. The first step is a full forensic audit of the cost basis. Look at every asset. Is it a retirement account? Is it a brokerage account? Is it real estate? If it is a traditional IRA or 401k, you are inheriting a tax liability. The government hasn't taxed that money yet. If you withdraw it all at once, you could push yourself into the highest tax bracket. If it is a Roth IRA, you are inheriting tax-free gold. In 2026, the rules for inherited IRAs are stricter than ever. Under the Secure Act, which is fully in effect now, most heirs must drain the account within 10 years. You don't have to take money out every year, but it must be empty by year 10. Here is the math trap. You inherit a $1 million traditional IRA. You are 30 years old. You leave it alone for 9 years, letting it grow. In year 10, the account is worth $2 million. You are now forced to withdraw $2 million in a single tax year. That withdrawal is taxed as ordinary income. You will likely lose 40% of that to federal and state taxes. That is $800,000 lost. Step 2. The 10-year tax bracket strategy. You must plan the withdrawals to fill up your lower tax brackets every year. If you earn $100,000 a year and the next tax bracket starts at $200,000, you should withdraw roughly $80,000 from the IRA every year. You pay tax on that withdrawal at a lower rate. You smooth out the tax hit. Over 10 years, you save hundreds of thousands of dollars compared to the wait and dump strategy. Now, let's talk about the psychology of being broke. Why do heirs lose the money? It's called sudden wealth syndrome. When you inherit money, you mentally separate it from your hard-earned money. It feels like free money, and free money gets spent on depreciating assets, cars, boats, vacations. Step 3. The 3-month pause. This is the most critical action step. When the money hits your account, you are emotionally compromised. You are grieving. You are not capable of making rational long-term decisions. Park the cash in a high-yield savings account or a money market fund. Do not invest it. Do not spend it. Give yourself a mandatory 3-month cooling-off period. Hire a fee-only financial advisor, not an insurance salesman, not your buddy who trades stocks, but a fiduciary. Pay them for an hour of their time to build a preservation plan. Let's look at wealth preservation. How do you keep it? Step 4. The 3% rule. Old advice was the 4% rule. Withdraw 4% a year, and you won't run out of money. In 2026, with inflation volatility and market uncertainty, 4% is risky. If you inherit a lump sum, aim to withdraw only 3% or less annually to preserve the principal. Let's look at the numbers. You inherit $1 million. Scenario A. You buy a $200,000 boat and a new house. You spend $400,000 up front. You have $400,000 left. At a 4% withdrawal rate, that generates $16,000 a year. You haven't changed your life, you've just delayed bankruptcy. Scenario B. You invest the full $1 million in a diversified portfolio. You take a 3% withdrawal, that is $30,000 a year in passive income, forever, growing with inflation. You have created a permanent salary increase. This brings us to the family bank concept. If you are the parent watching this, trying to figure out how to leave money to your kids without ruining them, 2026 estate planning looks different. Don't just leave a check. Leave a incentive trust. Step 5. Incentive trusts. Instead of giving your child $1 million at age 25, you set rules in a trust. The trust pays out a match for their salary. If they earn $50,000, the trust pays them another $50,000. They learn the value of work. The trust pays for education or starting a business, but requires a business plan. This protects the heir from their own bad decisions and protects the capital from the third-generation curse. For the heir receiving this, don't fight the trust. Understand that the person who created it knew the statistics. They are trying to save you from becoming a broke statistic. Let's talk about real estate specifically, as this is a major inheritance trap. You inherit your parents' home. It has a paid-off mortgage. It's tempting to keep it for sentimental reasons. But look at the carrying costs: property taxes, insurance, maintenance, and in 2026, potentially higher utility costs. If the house is worth $500,000, and you rent it out, can you generate a profit after all costs? Often, heirs keep a house that sits empty or is rented to family members at a discount. This is dead money. Sell the house, take the tax-free step up in basis, invest the cash, use the income to buy your own memories. Sentiment is a luxury you cannot afford if it bankrupts the portfolio. Let's recap the estate planning checklist for 2026. If you are the one leaving the money, review your estate tax exposure immediately. The exemption limits are changing. Consider a grantor-retained annuity trust to freeze asset values for tax purposes before the limits drop. Set up incentive trusts, not simple wills. If you are the one receiving the money, pause. Do nothing for 90 days. Audit the cost basis. Do not sell assets until you understand the tax implications. Create a 10-year tax plan for any inherited IRAs. Do not spend the principal. Treat the inheritance as an income stream, not a shopping spree. Wealth is hard to build, but incredibly easy to destroy. Most heirs fail because they view an inheritance as an ending, the end of the struggle. But for the smart ones, an inheritance is just the beginning. It is seed capital. If you treat it like a lottery ticket, you will be broke. If you treat it like a business, you will build a legacy. The choice is yours. Don't be the 70%. Be the 30% who figured it out.